Hello clients and friends, I'm Paul Hutton, President and Wealth Manager with Hutton Wealth Management, and it's my pleasure to bring our economic update for the first quarter of 2022. At Hutton Wealth Management, we partner with clients and believe an educated client is our best client. While we will always try our best to help you, when it comes to your finances, we believe that knowledge is power. One of our missions is to share with our clients any knowledge that can better help them make an informed decision. What a whirlwind first quarter. Just when a sense of normalcy just seemed to be realized during the first quarter of 2022, the world was thrown into another hardship as Russia invaded Ukraine. For investors, this added more fuel to the market volatility. Coupled with inflation and rising interest rates, the first 3 months of 2022 were a roller coaster ride for equity markets, which had their worst period since the start of the pandemic in the first quarter of 2020. Volatility is a great word to describe the first quarter of 2022. After several significant drops at the end of the quarter, equity markets began to rally. For March, the S&P 500 rose more than 3%, while the Dow Jones rose only 2.2%. Despite that upward move, they did not reach the same values that they were at the beginning of the quarter. The U.S. stock markets closed their first losing quarter since March of 2020. The S&P 500 closed down 4.9%, and the Dow Jones Industrial Average closed down 4.6%. Inflation is currently at a 40-year high. In February, inflation rose to approximately 7.9% from the 12 months earlier. In March, the numbers are about 8.5% currently. Although there is no established formula inflation target, the Federal Reserve generally believes that an approximately 2% inflation rate is acceptable. As you can see from the chart, inflation has blazed upward over the last 2 years. Inflation is a decrease in the purchasing power of money, reflected in the general increase in the price of goods and the services in the economy. Today, prices for most consumer goods are significantly higher than they were just a few years ago. It's virtually impossible to not be affected by this inflationary pressure somewhere in your daily life. Whether it's at the gas pump or at the grocery store, consumers are feeling the squeeze and are looking for new ways to cut costs and spending in their lives. The much anticipated rise in interest rates came in March as the Federal Reserve raised the Fed funds rate for the first time since 2018. The benchmark Fed funds rate was increased by 0.25% to rest between 0.25%. Bond interest rates move in opposite directions. When interest rates rise, existing bond prices tend to fall, and conversely, when interest rates decline, existing bond prices tend to rise. Recent times have not been very beneficial for bondholders. Bonds, many times considered to be more stable than equities for investors. This quarter, however, volatility in long-term bond markets was high, and U.S. bonds had their worst quarter in over 40 years. Short and mid-term bond yields increased this quarter, however. At the quarter's close, the 10-year Treasury Yield was at 2.35%. This is a significant jump from the 1.5% yield that the 10-year bond held at the end of 2021. As interest rates rise, new bond yields are likely to change, and investors are expecting short-term yields to reach 3% in 2023. That would be really good if they did. This is a good time for any bond investors to review their holdings. If you'd like to explore any exposure that you have to bonds and whether they're still a good fit for your personal goals, please contact us. We're monitoring how the Fed movements and the rise in interest rates are affecting not only just bond yields, but the overall market. Safety comes with a cost. Have you ever seen what interest rates banks are currently offering to savers right now? According to Barron's, the average bank money market rate on April 3rd of this year was 0.33. and the average 12-month CD was 0.2. Who can live on 0.33 and 0.2? Nobody can. For many investors, today's ultra-low rates might not help them reach their goals. Therefore, equities should be considered as part of a diversified portfolio. As we continue the second quarter of 2022, many factors could complicate equity market performances. So investors need to be prepared. Equity markets and volatility is still present, and we stand by our mantra to proceed with caution. So what are investors looking at for this upcoming quarter? Watch out for more interest rate hikes. We're expecting 2 more to be coming out in May and June. If you're planning on buying a house or a car or borrowing, is getting ready to be a lot more costly as we move forward. There are going to be many variables that could affect the speed and the direction of the economy, including Russia and Ukraine, COVID, interest rates, and savers need to become more disciplined and focused. As your financial advisor, we are keeping track of any changes that could affect your personal situation. Here are some things that we feel would be beneficial to do in light of rising interest rates. First, review all of your income producing investments. Next, lock in your mortgage rates or consider refinancing to get a better rate if you haven't already done so. Next, maintain liquidity in all near-term needs. Then, reevaluate and confirm your cash flow needs. At some time this year, we can conduct a full review of your financial plan if you'd like for us to. During this review, we can look at your risk management, how well you're diversified, and revisit your time horizons to make sure that all of these things are still compatible with your current goals. There is currently a lot of rise and noise and distracting all over the place. Equity markets, volatility, interest rates increasing, inflation, global unrest, the pandemic have all given the media, analysts, and economists much to talk about. Recently, 2 words that have been widely used are stagflation, which means high inflation, high unemployment, and slow or no economic growth. And then the second one is the R word, recession. And that is recognized as 2 quarters of negative GDP. However, in respective of what is present, it is wise to not try to predict the future, but instead focus on your long-term goals and objectives. Having a solid investment strategy is an integral part of a well-diversified, holistic financial plan. Staying disciplined and following that strategy during times of volatility is equally important. As your financial advisor, we are here to help you pursue your goals. If you'd like to revisit your financial plan or discuss any concerns or ideas, please call our office as soon as you can or bring them up at your next scheduled meeting. As a quick recap, here are some key things that we want you to think about. Equity markets are still experiencing volatility, which is part of the investment experience. Interest rates are on the rise and expected to be increasing faster than originally anticipated. Inflation is at an all-time high. There are many factors that could affect the direction of the economy and the markets. Caution is still to be the principal notion for investors. Stay the course. And as always, call us if you have any questions or concerns. We appreciate all of our clients. As a client benefit, you can add the names to our distribution list to receive newsletters and presentations like this one. We hope that you will take time and take advantage of this opportunity to add 2 or 3 or 4 or 10 names to our list. Our goal is to continue to help others, and some of our best clients will be referred to us by our existing clients. So please let us know the names of anyone you feel that could benefit from our services and information. Again, one of our primary goals is to keep clients informed, and we appreciate you watching our update. Please call us if you have any questions.